In a similar way to the transfer of inventory from one entity to another, parent to subsidiary or subsidiary to parent, and the profit made on that, we can also consider the transfer of tangible assets. And this is what this question is about, the transfer of PPE sold by the parent to the subsidiary. And there's two parts to this. We notice here, if we read the question, the parent sold PPE to the subsidiary for $25,000. The original cost was $50,000, and its carrying value at the date of sale was $20,000. So it's already been depreciated down to $20,000. And therefore, if the carrying value was 20, held on the books at 20, and it was sold for 25, the parent has made a £5,000 profit. And that's absolutely fine. As a single entity, the parent can do what it likes. But when we come to consolidate, we're going to have to remove that £5,000 profit. Can't really make a profit from yourself. We've come across this before, and it's the same issue again. In addition, when we're transferring PPE or depreciable assets, we have to consider the depreciation problem. And the problem is this. Initially, or before the sale, the PPE was held on the books at $20,000. There was 2 years left to depreciate. We've given it here economic life of 5 years, 2 years remaining. So each year the parent was depreciating this asset at $10,000. So $10,000 per year depreciation. Now, when it transfers over to the subsidiary at $25,000, the subsidiary is then going to start depreciating that for the 2 remaining years at a higher value. So that is going to be $25,000. That's going to be $12,500 per year. So, of course, there's a discrepancy there. The asset has not transferred out of the group. It stayed within the group, and yet we're charging an expense of £2,500 greater depreciation. So we need to remove that as well. So the first part is the profit, and the second part is the depreciation. And we've kind of done the calculation here, but we'll do it more cleanly. Let's just move this down. Let's move that down to there. Let's start with the profit element. So the profit is going to be, how much is the profit? Well, it's sold for $25,000, and the carrying value was 20. So this is a very simple calculation. Profit equals 25,000 minus the carrying value equals £5,000. Simple enough. Let's make a note of that. And the depreciation well, we have it here. The parent was depreciating at of the carrying value equals 20,000. Depreciation per year was 10,000. And for the subsidiary, the carrying value, which is the purchase price, was 25,000. So the depreciation per year was 25 divided by 2, because there's only 2 years remaining now. So that's 12,000. Let's do that calculation in full. 25,000 divided by 2, which equals 12,500 per year. Just tidy that up. Okay, so the difference, of course, is one minus the other. Difference equals 12,500 minus 10,000, which equals 2,500 per year to be removed from the balance sheet. Okay, so let's just summarize the adjustments we need to make. These are all going to be made on the selling entity, which in this case is the parent. So for the profit, we are going to, what are we going to do? The profit is overstated, so we need to reduce the retained earnings, which means we're going to debit retained earnings by this amount, and that's 5,000. And therefore we are going to credit the asset amount by the same amount of 5,000. And for the depreciation, we are going to, let's see, the depreciation. We need to reduce, or we've over depreciated, so we're going to have to increase the asset, which means we're debiting the asset. Debit to increase assets, and how much was that? 2,500. And in this case we're going to credit retained earnings of by the same amount, 2,500. So you can see in some ways these two adjustments, just tidy that up, these two adjustments balance each other off slightly. The retained earnings from the profit, it's overstated the retained earnings, and yet we've depreciated too much, so we need to kind of credit retained earnings slightly. So the balance, if you balance both of these accounts, is 2,500 in both the retained earnings and the TNCA. So we can do that directly. We need to debit 5,000 from retained earnings. So we'll just make a note here, minus 5,000. And we need to, so the balance on that is a credit to the TNCA, and that's going to reduce, that's going to reduce TNCA. So the balance sheet still balances. We've reduced both sides by 5,000. Oh, sorry, what am I doing? 2,500 on each one. There we go. So let's just go through that again. We reduced retained earnings by 5,000, and then we credited it by 2,500. So we're reducing by 2,500, which is this figure here. And tangible non-current assets, we are crediting to reduce, and then we're debiting to increase by 2.5. So that's a net change of negative 2.5. So that is the two adjustments. One for the profit side, because we've overstated profits by selling at a profit within the group, and the depreciation side, because we've sold at a profit, we're now depreciating at a higher rate, and we need to make an adjustment for that. These are the two adjustments, one for the profit and one for the depreciation, and then we net them off. But I'll put the adjustments in here, and when we come to do the consolidation, we will just add that into those figures. We'll also use the adjusted amount when we come to do the retained earnings calculations. So that's it. That's the transfer of non-current assets.